We'll now start to talk about transfer pricing. Now, transfer pricing is one of the most important things in really all of what we study. But the real interesting aspect of it is that it's not knowing the law. It's knowing economics. It's being aware of value, where value is, how you look at what a company does and try to think about, which we'll get into in more detail, but how you think about what functions does an entity actually conduct, what risks does it accept, what benefits of gain, risks of loss does it have, and then what assets does it have. And those assets can include not only tables and shares and computers and machinery, but, of course, intangible property. And valuing intangible property is absolutely miserable. So this becomes a very, very subjective area. It's a very, very great significance. Why? Why can transfer pricing be so significant? When a transfer pricing adjustment is made, let's say that there's been, let's say one company is selling tables as inventory to a related company and is selling these tables at 100 each. Now, over the course of the year, maybe there's 100,000 tables that are sold. IRS comes in and says, well, gee, you manufactured these in the United States. You're selling them to your overseas subsidiary at 100. The subsidiary is selling them to somebody else unrelated at 150. Well, if the IRS says, gee, the transfer price should have been 110, that's a 10% of selling price adjustment. 10% of selling price adjustment. What's net income? Net income is, of course, selling price, less cost of goods sold, less expenses, and we come down to a net income. What's a really good margin in a lot of industries? 5% of sales? 10% of sales? 1% of sales? Obviously, it depends on the industry. Depends on the nature of the industry. But the point is that the adjustment that's being made is focusing on the selling price. And if there's a 10% adjustment at the selling price level, that can easily double, triple, quadruple the amount of net income. So relative to the amount of net income, a transfer pricing adjustment can be catastrophic. Absolutely catastrophic. The numbers can get very scary. So we'll talk a little, well, I think I left a slide in here which mentions that, and if I don't, I'll mention something about that. Okay, in terms of agenda, we'll try to cover what I'll call, some macro view issues. Why does society think it's important? Why does the Treasury and the IRS consider this one of the major risk areas in taxation. And of course, on the other hand, taxpayers. It's the probably in the minds of most large companies, this is the single biggest tax risk out there. Single biggest tax risk out there. Anyway, we'll go through a few of these things. Okay, so from a macro standpoint, is transfer pricing something that should concern us if we look at a bit of information, combined statistical information, many companies? And notice that the amount of profit, the weighted average of profit by foreign subsidiaries of U.S. companies in the G7 countries, the UK, France, Germany, Japan, those kinds of countries, the weighted average is 0.6 of 1%. That's not a large number, but who knows? It might well be reasonable. But now look at the various tax havens, countries that you look at and you say, well, gee, they have lots of activity there, right? And the numbers are just astronomical for, of course, the British Virgin Islands, Cayman Islands, and Bermuda. I mean, you look at this and you say, well, gee, maybe there's an issue here. Maybe there's some issue out here that makes transfer pricing an important matter.
Professor?
Yes, Glenn.
I looked at that chart for about 15 or 20 minutes and couldn't make out even the basics. So I don't understand a few things.
Okay.
One, if these are subsidiaries in a foreign country, why would their earnings and profits be included in that foreign country's E&P? Number two.
Well, it is. It is. That's the point is that the profits that are within those subsidiaries in these various countries are high for the, a little farther down you go on the chart, for the major industrial countries where they're, which are generally high tax countries, relatively speaking. In those countries, they are conducting certainly plenty of business, but they're not reporting a lot of profits. They're not reporting a lot of profits.
But if they're a subsidiary, let's say the Cayman Islands, how could the U.S. profit and earnings be greater than their GDP if it's included in their GDP?
Okay, I'm sorry. Let's say Bermuda. This is presumably a number of companies that are subsidiaries of U.S. companies. Bermuda is very often used for insurance operations, so I suspect this may well include things that are going on in the insurance industry. But in any case, whether it's a some sort of financial business, whether it is buying and reselling products, because of transfer pricing, artificially high levels of profit are being earned in these countries, in these companies that are located in those locations. Now, this, of course, is composite information. Is it Is it exact? Is all of it as a result of transfer pricing? Might there be other factors? Yes, of course, there probably are other factors, and this may not be a perfect picture, but it certainly gives an indication that maybe there's an issue.
How do you always buffer thinking about different companies, why do they always buffer? They use one of the islands as a buffer to everything. Because I'm following Glenn and trying to see why they would allocate so much earnings and profits in the same place as a buffer.
Oh, okay. Well, I think, let me see if I can answer it this way. You tell me whether I'm getting to the right point. If a U.S. company is going to be doing business overseas, and the U.S. company wants to do it in a fashion which minimizes the amount of foreign tax being imposed, and also wants to do it in a manner that avoids subpart F. Now, this is where later on, when I say bringing it all together, and we'll talk about the supply chain planning, which many companies are doing. You have many U.S. companies that are consciously structuring their activities outside the United States to, number one, maximize the amount of income reported outside the United States rather than inside, in order to achieve deferral, to do it in a manner that avoids subpart F so that they don't lose deferral, and then also they do it in a manner to avoid as much as possible taxation by other countries. Because if you pay a lot of tax to another country, well, you don't have much benefit from deferring U.S. tax. Does that get to the point?
Perfectly, because now it all makes sense why they
Yeah, the basic concept, and those of you who can remember back to the first session when we looked at, let's say, some similar information for Cisco, or talked a little bit about the fact that Google was getting beaten on the head publicly for doing this. This is a major objective of pretty much every U.S.-based multinational. Reduce my effective tax rate on the financial statements. Achieve indefinite deferral of U.S. tax. Reduce levels of foreign tax. This is the goal. And again, what we're studying is hopefully giving you tools to not only understand it, but help companies do it. Or on the other hand, if you choose to choose a career with the IRS or Treasury, understand it so you can maybe do something about it. Or if you want to write your congressperson, help them decide what to do. Understand it enough to know what perhaps could be changed. Now, just to mention it, I don't know how many of you looked at one of the items that I sent this past week, which was the Treasury Department Green Book for President Obama's 2012 budget. But a couple of the items in there are directly pointed at this kind of thing. Will they actually make it into legislation? Who knows? But this is a principal area. Okay, return on assets. Okay, average for U.S. manufacturing subsidiaries, 8%. And again, do we see a lot of manufacturing in the Cayman Islands? Well, not necessarily, but still the percentages are, 2 to 3 times what 2 to 3 times what it is on average. This pie chart shows that the 2 biggest players, which are healthcare and IT, healthcare includes your pharmaceutical industry. And again, R&D conducted inside the United States, but where do you own the intellectual property that comes from it? Well, to the extent that ownership can be somewhere different from the location where the work is done to create it, this is an important part of this puzzle, piece of the puzzle. And in terms of specific companies that have undistributed foreign earnings, notice General Electric at the top, and let's see, this is 2008 information, $75 billion. Now you know that they would love to see another one of these tax holidays to encourage bringing money back home. Now with Cisco, if you remember the slides again from the first session, we saw how steeply this amount of deferred income in overseas subsidiaries, how steeply the amount of it rose from 2006 through 2010. Because there was an incentive because of the 2004 tax holiday to, in a sense, bring it home and pay only 5.25%. So it would be interesting to see. I haven't looked for it, but one could get the financial statements for General Electric for the past 5 years and look at the tax footnote and see how much each year was there of undistributed, or let's say amounts that are stated to be permanently reinvested overseas, or permanently invested overseas. So be interesting to see how their, what the slope is of their curve. Oh, this was the slide that I didn't remember whether I included, but the point being that one taxpayer, which is a British company, settled on a tax adjustment of $3.4 billion. The numbers can get very big. And again, they get big because you're talking about a percentage of the sales price of the product. You're not talking about, gee, the net income should be a little more or a little less. You're talking about the sales price. You're adjusting the sales price. And percentage-wise, it can be high, and it can be astronomical in terms of the actual amount of additional taxable income. This was just the result of a settlement. They didn't actually have they didn't go through an actual court procedure. If I remember correctly, I think they were close to it, and they settled before it actually went to trial. But this was a settlement. what might the adjustment have been if they really lost big in an actual court decision? Okay, again, sort of a big picture point. We've said before that the congressional intent is to never let money get out of the hands of a U.S. taxpayer without there being a U.S. tax. And if you look at, let's say, categories of people, or categories of taxpayers, I should say. Let's go to the 877 and 877A one first. Okay, I'm an individual. I have U.S. citizenship. Gee, can I get out of being a U.S. taxpayer? Well, yes, I can. I can renounce my citizenship and take up citizenship somewhere else. And if I had a lot of money that, or let's say a lot of unrealized value that I want to realize next year, and I want to avoid U.S. tax on it, well, gee, maybe I should go down and renounce my citizenship immediately. Well, there are rules to prevent an individual from, in a sense, avoiding tax by renouncing citizenship. And that's your 877 and 877A. So individuals have this issue. Okay, what about tax-free transactions? We all know and love Section 351, transfers to a controlled corporation by one or more persons who afterwards own 80% or more of that, of that transferee, that corporation to which we've transferred assets. No gain or loss on that transfer. Well, Section 367 covers that. It says, okay, the general rule is you cannot have tax-free treatment to the extent of gain if you transfer assets, outside the country in exchange for shares. You can't have that tax-free 351 treatment. So that's tax-free. So we've mentioned individuals in terms of expatriating, as it's called, the giving up citizenship. We've mentioned tax-free transactions, like 351. 367 says, you can't do that, but there are some exceptions. And then 482, which is your transfer pricing, it focuses on actual transactions that are normal taxable transactions. If something is bought or sold, and or services are being performed, or a loan is being made, those are normal taxable transactions, not covered by any special, Type A reorganization provision, or 351, or any of the other tax-free exchange rules which you studied in the corporate course. So you've got, in a sense, those two alternatives. Real taxable transactions, and then tax-free transactions, and the third one is individuals who give up their citizenship, but a transaction is either one or the other, ignoring the individual one. It's either one or the other. If it's a tax-free transaction, 367 applies. If it is a real, normal, non-tax-free transaction, 482 applies. Now, in some cases, 367 principles refer you back to the 482 rules, but you've got this basic dichotomy, this basic split, and you always want to understand which direction you're going on the transaction you're reviewing, so you are looking at the right concepts and the right rules to apply.